Well, joining us now is Francisco Blanch, Bank of America Merrill Lynch Global Head of Commodities, joins us from Nashville. Francisco, great to see you. Why will Saudi Arabia be more cautious this time around, despite the hawkish turn from the White House?
Thanks, Alex. I guess we have to go back to what happened back in November. And obviously, President Trump had a last-minute change of mind and handed out 8 waivers, which effectively triggered a very significant sell-off in the oil market throughout most of the month in November and December. So I think the Saudis are gonna be holding tight here, see what the final outcome of this is on May 2nd, which is only a few days away at this point, and then see how those reductions in Iranian exports are actually accomplished. So they're going to be monitoring the situation carefully, and obviously they cannot really afford another sell-off in oil prices down to $50 a barrel. So my sense is the Saudis, as well as the Abu Dhabis, are going to be watching the price carefully and adding barrels as needed. And I think the same thing is true for U.S. shale producers. I don't think they're going to rush to ramp up supply like they did last year. Capital discipline is the name of the game in the U.S. shale patch. So I would expect this rally to be more sustained. We have an $82 a barrel target for Brent, which, by the way, we've had since November of last year. And we see that price those prices in this quarter, and then we think there's a risk of a further spike into year end.
So, Francisco, if in fact the oil markets are basically saying, show me the money, show me the real curtailing of Iranian exports, what will it take for the market to react?
Well, I mean, I think the markets, commodity markets tend to be real, kind of real-time kind of markets, in the sense that they do not anticipate like an equity would. Equity markets are forward-looking instruments. Commodities are basically looking at supply-demand today. Occasionally, look 1 or 2 months out. And I think in this particular case, they're going to be quite cautious, watching the reduction in Iranian exports, because remember, some of the Iranian partners, like China or India or even Turkey, may decide that they want to keep importing barrels despite the risk of U.S. sanctions. So we don't know how that's going to play out. So I think Saudi Arabia has rightly said, as soon as those reductions start to take place, we will be filling up those barrels for Iran's customers right now. But we're not going to do it as soon as possible. We're just going to wait until we get the call.
So, Francisco, is the curve mispriced? Because if you take a look at the Bloomberg here, this is the curve now for Brent versus just a month ago. We've obviously seen a huge re-rating in the front end by, I don't know, about $10 or so. But the back end really hasn't re-rated as much. Is that appropriate? Is that enough being priced in?
Right. So I think it's a great point that you're raising. We've been making the case that, I mean, oil longer term is a $50 to $70 commodity. So it's hard for the back end to move away from that range. Now, here's the risk, right? The risk is that the front end keeps going up, and eventually, because let's say that we end up losing a chunk of Libyan production or some other country, or maybe we have an uptick in the global economic cycle because the U.S.-China trade negotiations eventually get to the right place, and we have an uptick in global PMIs. I think that's what could actually start to pressure prices higher, and it may be a little bit more difficult to do it, to stop a rise in prices in an accelerating economic growth environment. Remember, so far, growth has been decelerating for months now, for quarters, right? So I think if we have an upturn in global growth into the end of the year, if this upturn comes together with all these fuel specification changes, IMO 2020, basically this bunker fuel change at the end of the year, this is the kind of risk that could create a spike into year end. We don't think it's very likely. We think it's just a risk, but something to really watch carefully. Oil could be a lot higher than it is today under those circumstances.
So what's a lot higher?
A lot higher could be as high as $100 a barrel. I mean, I don't think it's a base case scenario for anyone. And again, for us, our base case is that we hit $82 Brent. But I do think there's a risk that prices keep rising because Heading into year end, we have this big bunker fuel specification change that is going to lead probably to a big jump up in oil demand globally, just because some of the bunker fuel that is not going to be used in ships anymore has to be used by some other industry, mostly power generation, and in the meantime, the shipping industry is going to move to a lighter fuel, which will have to be produced, and refiners will have to put more crude oil to create that incremental fuel. That's basically marine diesel. So that's one big reason. And then, as I said, I think the other factor to watch is whether the cycle is sticking up, and the green shoots in China and the green shoots in other countries that we're starting to see actually materialize and lead to a stronger growth, weaker U.S. dollar environment as well, right? Those are the kind of things that we'll need to see to get that spike.
Francisco Blanch of Bank of America Merrill Lynch is going to be staying with us. In the meantime, as we've been saying, there's a lot of earnings coming in this week. A third of all U.S. S&P companies will be reporting. For report card now, we welcome Bloomberg's Taylor Riggs. Taylor?
Yeah, David, so I'm going to kick it off here with Twitter. Of course, we know that in the first quarter, those monetizable daily active users are topping estimates now, coming in at about 134 million versus estimates of 128, and that is up from the fourth quarter when there was about 126 million. Now, forward guidance in terms of sales for the second quarter was important. It looks like it missed a little bit, with the average analyst estimate of 800 million missing by about $20 million. Still, though, you're getting shares rising by about 7% this morning. First quarter ad engagements are up 23% on higher ad impressions and click-through rates, but the cost of that ad engagement is down about 4% on like-for-like price decreases across most of these ad formats. I also want to shift over to Lockheed Martin. Those shares were up as much as 7%. They're boosting their full-year view and looking at free cash flow from operations that is now higher to about $7.5 billion. You can thank defense spending for a lot of this. Production of those F-35 fighter jets and arms sales are helping that backlog. That backlog rose $3 billion this quarter, now growing to a record $133.5 billion. I also want to take a look at Coca-Cola, as we've talked a lot about the pricing pressure that we are seeing. Now, those shares were up as much as 3%, reaffirming their full-year sales and earnings guidance as well. Now, Pepsi has done a very good job of passing along those price increases, and you are seeing that as well with Coca-Cola this morning. They are saying, for example, in their North America region, their price mix grew by about 4% in the quarter, driven by strong pricing and a mix within the sparkling soft drink portfolio. Alex, David?
Great stuff. Thank you so much, Bloomberg's Taylor Riggs. Well, coming up, to stimulate or not to stimulate, that is China's dilemma. We're going to discuss China's economy and global growth coming up next. This is Bloomberg.
The Hewlett-Packard Enterprise Green Room is brought to you in partnership with Bloomberg. Hewlett-Packard Enterprise, accelerating next.
Introducing Overlight, the quick and easy way to instantly add lighting to any room. With the cordless Overlight, you don't need costly installation or complicated wiring. There are no plugs and no switches. Simply peel and stick to any ceiling or wall and let the built-in motion detector do the rest. The secret is Overlight's advanced light sensor, which will only activate when the motion sensor detects movement in the dark. They're battery operated and energy efficient, automatically powering down if no motion is detected after 20 seconds, saving you money. Overlight is equipped with an onboard COB lighting system featuring 24 ultra-bright white LED bulbs emitting 300 mighty lumens. And the smart sensing technology detects motion from up to 15 feet. Now you have bright lights in places you never imagined, hands-free and without having to worry about complicated installation. Add light to your dark pantry when grabbing a quick snack, or illuminate that closet so you can see all the way to the back. Don't wait. Go to buyoverlight.com and order yours today.
When it comes to your small business, it's hard to predict when you'll need financing and what makes one loan right for right now. That's why Smart Biz Loans is rated the #1 online marketplace for SBA loans. We help you pre-qualify for both low-cost SBA loans and affordable fixed-rate term loans through our bank partners, all with one easy application.
It was way easier, way faster, and at the end, we got the loan.
So go to smartbizloans.com. Apply now.
I found a place in my heart. I found a light in the dark.
Bloomberg Daybreak. I'm Viviana Hurtado with your Bloomberg Business Flash. Twitter topping first quarter sales projections and reported strong user growth. The company's changes to its social media service are drawing a wider audience of consumers and advertisers. Twitter's daily active users climbed from 126 to 134 million. Shares of Hasbro soaring in pre-market trading. The toy maker posting an unexpected gain in first Q sales. It's a sign Hasbro is recovering from the collapse of retailer Toys R Us. The 2% increase in revenue is the company's first in 6 quarters. United Technologies raising its profit forecast for the year. The parent of Pratt & Whitney seeing strength in the aerospace market. CEO Greg Hayes wants to narrow United Technologies' focus on aircraft parts. Next year, the company will separate the elevator and climate control divisions into standalone entities. And that's your Bloomberg Business Flash. David.
Thanks so much, Viviana. All roads lead to China, at least when you get talking about global growth. But yesterday, we got word from the Politburo that the markets took at least as letting off on the accelerator bit. According to the Xinhua news agency, the Politburo decided, quote, monetary policy needs to be neither too tight nor too loose and should be fine-tuned in a timely and preemptive way based on economic growth and changes in price situations. Still with us are Francisco Blanch of Bank of America Merrill Lynch, and joining us now is Chris Watling of Longview Economics. So Chris, let's start with you. Welcome, first of all.
Thank you.
China. Do you interpret what came out of the Politburo the way a lot of analysts are, that basically they're saying, we don't need to do any more stimulus now. We can sort of take it easy for a bit?
Yeah, I mean, I think what they're signaling is they've done an awful lot. If you look at credit growth in the first quarter, year on year, it's up about sort of 30%. So they've been hitting the accelerator quite hard, and I think they're probably just easing off and being a bit more balanced about it. And there's no doubt that the Chinese data's turned and the cycle's turned. I think the Chinese credit cycle's clearly turned. The stock market's on a tear, not overnight, but generally, and I think it's an interesting looking situation.
They've done an awful lot. Is it enough to sustain global growth?
I think it's enough for now. I think they're a key piece of the global puzzle, and they've done enough to turn the global economy upwards, along with what the US is up to. Yeah.
Francisco, how do you weigh in on this? Because you had Citi coming out being very constructive on global commodities for the second quarter, in part because China is going to be the key engine of growth. Do you see that playing out, or do you see strength in commodities as a supply story rather than a demand story?
Well, I mean, if you look at, for example, the sales of vehicles, cars, other appliances in China, it's been pretty depressed for quite some time. So I think stimulating the consumer through different fiscal measures, which is what the Chinese government has been trying to do, I think should be quite positive for the year. So in some ways, they have an opportunity to kind of keep pushing growth a little bit higher and stimulate it where it matters most, which is helping the industries that have struggled throughout most of 2018. And again, I think the car manufacturing industry is one of them, one of the main ones. So to me, I mean, I think the data points are coming in a little bit better. The one thing that's not really improved materially, we've just had kind of scattered data points, is trade, and that's why I think the U.S.-China trade deal is so key to the whole outlook for the next 12, 18 months. Because remember, if we get that trade deal done, and that trade deal stimulates a whole bunch of commerce between China, U.S., and the rest of Asia, we're also going to lift the European economy, particularly the German economy, which has been the weakest link in Europe in the past few months.
And the question, though, is like, how does all of this then feed through to inflation? We talked to Jan Hatzius of Goldman Sachs specifically about oil and inflation and the pass-through. Here's what he had to say.
Oil prices are always complicated, I think, because they have opposite effects on inflation and on activity. So in the short term, of course, it's inflationary if you look at the headline indices, and maybe a little bit on the core. But oil prices also higher oil prices tend to have a negative impact on activity. And on net, I think that's probably still true, even with the rise of shale, which tends to dampen activity over the longer term and maybe also take away some of that initial inflation boost.
We got Francisco's read on oil in the previous segment. So what do you feel is the pass-through then to realized inflation?
From the oil price,
or commodity price in general, because it comes from China, goes to the commodities, and then goes to inflation. Yeah,
there's a lovely little connection you can do between Chinese producer price inflation and 18 months for what happens to U.S. core consumer price inflation, which is kind of what you'd expect. The manufacturer of the world, eventually it feeds through. But if you look at Chinese PPI at the moment, it's zilcho. I mean, there's hardly any of it. I mean, it's been slowing for 18 months. So I wouldn't worry about core U.S. inflation for quite a while. I don't think there's any issue there whatsoever. Not only the commodity story, but the technology story and the demographics and all sorts of stuff. So I think it's tame. The Fed's been signaling it. It's great. I mean, they may even cut rates this year.
Well, that was my question. I mean, is there a risk to the downside in inflation, actually, that there's too little inflation?
Yeah, I think there is. I mean, I think there's, you know, maybe not too little, but not enough to worry anyone, put it that way. There's no problem with not having too much inflation. I don't think that's a big issue, as long as it doesn't go negative. I mean, I know they worry about deflation kicking in, but 1.5% is fine on core PCE. Yeah, and it could soften a bit, and I think the Fed are teeing up for having the option, if they want it, to cut rates. I think that'd be great.
Base case, really, to cut rates, you think?
Well, I wouldn't say it's base case, but I think it's a reasonable probability that they could cut rates if inflation softens a bit from here. Yeah, why not? Why not take out an insurance policy if you're Fed governor on the recovery and there's no inflationary pressure?
At what point do we become concerned about moral hazard, essentially? That, in fact, in that kind of easing situation, you're going to get some real bubbles. You really get some anomalies.
Yeah, I mean, I think we should have become concerned about moral hazard 25 years ago. I think that one's in the dustbin. I mean, we should be concerned about it, definitely, but the system's set up wrong, and we're in a world of perennial, continual bubbles.
Well, if we wind up, so Francisco, to end with you, if we do get a world where you have more disinflation, shall we say, and maybe a Fed cutting rates, I mean, what do they do for commodities? They're supposed to be an inflation hedge. What do you do with this inflation?
Well, look, I mean, we put a piece out entitled Exporting Expand Deflation. And if you look at the U.S. for the last 10 years, we've had this massive expansion, economic growth with very little inflation. And the case we've made is that the U.S. will be exporting this expand deflation, i.e. expansion with disinflation, to the world through the energy channel, through massive export growth in gasoline, diesel, crude oil, propane, butane, LNG, you name it. And I think this continues for many years to come. So it's actually a really good thing for global growth. The one thing that's kind of getting a little bit in the way is the foreign policy objectives of the Trump administration, trying to tackle at the same time regimes like Venezuela and Iran within a very short time frame. So it is those foreign policy objectives that are coming in the way, but generally we agree that we're going to have all this energy export growth probably support economic activity in emerging markets for many years to come. It's a good thing that people in Bolivia and Ecuador and Africa and all around Asia will have cheap fuel prices and will be able to cook with propane as opposed with wood or charcoal. So these are really good things, right? I think overall for growth.
Francisco, thanks so much for being with us. Really great to have you with us. That's Francisco Blanch of Bank of America Merrill Lynch. And Chris Watling of Longview Economics will be staying.